Welcome back, traders, to Sideways Academy. My name is Ali Casey. This is the final part in building a portfolio to trade a single instrument on multiple strategies inside a portfolio. So let's jump in. In the previous videos in this series, I showed you how to build a bias portfolio on crude oil. So once you build that map, you will get some patterns shown, and you can use those patterns to trade that instrument on daily basis and build a portfolio out of it. By now, you should have built some strategies, and today I'm going to show you how to combine them in a portfolio and what you need to do. So all the strategies now have a stop loss, some of them have a stop target, and some of them has probably a filter or none. And we want to combine them in a portfolio. Once you save the strategies, we go to the retester, and let's bring the data bank, and then let's load the strategies. So let me load strategy 1. So that's a Monday. And let's load the other Monday. I actually have 4 strategies on Monday. So let me load all of them. So now I have 4 strategies on Monday with a stop loss and profit target, and some of them just with a stop loss and with mixed timing. So this is 1 to 5, this is 1 to 10, and then 8 to 10. So you can see 1 to 10 encompass 1 to 5 and 8 to 10, and then 13 to 15. And these are all short, of course, and this is long. And the way to test them now, because this is not a test, this is what came with the strategy. So double click on the strategy, go to strategy config, and apply strategy config to retester. Yes. So we just applied the strategy. Then we only need, because remember, all our testing was without commission. So let's go to commission, size based, and we'll do it. So it's $5 per full lot. When I do position sizing, I want it to change. And slippage 1. For some reason, slippage 1 should be $10, but I don't know why SQX is calculating as 2. Again, these are one of these odd things, but you know, you have to work with what you have. So you need to make this 5 slippage to count as 1 tick, which is 1 tick, yes? So I loaded this. I just added the slippage, and now I will test it again. So I will test the selected one, retest only selected, from results, put it in portfolio. This is just a bank that I put in. So let's start, and it should show up here. And then now this is the test. This is now the strategy is tested, and this is including commission, and I can check. Let's see. So let's pick something easy. So this is long, 12 to 66. We made we made 54 cents. So that's $540 minus $5. That's 435. And then 1 tick is $10. So that's 525. The accounting is correct. But remember, I had to trick it again. As usual, I have to do something to convince this software to do something right. But yeah, so this should be 1. So 1 tick should be $10, but I don't know. Anyway, so 5 is $10. So it's calculating correctly. It's done. This is good. And the results are here. Equity and trade analysis. All is good. And by the way, so Monday, Tuesday, Wednesday were in those hot seats in 2020. Remember when the price went negative and everything went crazy? Yeah, so 2015 is a crazy year, and we only lost 2. Well, this is just within the reason. Like, it's not an outlier. And you can see that I make more money in different years. So it's not an outlier, which is very good. We go back, results. So we pick the second one, double click on it, go to strategy config, apply, yes. And now we go to full settings, and the commission is 5, size based, and it's 5 here. And then we test, we put it in portfolio, we test only selected, and it's done. Now we go to the third one, double click. So now we tested all the strategies. They're all here in portfolio. Each one is tested with commission and slippage. They're all profitable, of course, we know already. And I can show you now, this is where the magic happens. So you can see this has 1275 days of stagnation. This is even more, 1470. This is less. And this is 862 and 36 drawdown. So these strategies are overlapping. We know we have this long alone between 13 and 15, and then we have 1 to 10 that encompass 1 to 5 and 8 to 10. So what we want to do is we want to combine first these two, long and the short, and then these two, and then these three. Because 1 to 10 encompasses all of these. If we take 1 to 10 out, we can use 1 to 5 and 8 to 10. We just want to see which one to combine is better. So let's start with these two. That's the long and the short. And we go to portfolio, merge, and let's call it Monday, long, short, portfolio. We're going to put it in portfolio. This is only merging the results of the strategies, not the code. So now we have this portfolio. It's beautiful. Let's pick now these three and merge. And now it's Monday, long, short, short, portfolio. And let's see. It's almost the same stagnation area, and we almost make the same amount of money. But obviously, it's because I'm doing more trades and I'm losing more commission, and that's why it's less. So now we know that combining 110 that encompass both of them is much better than these two separated and the long. So let me get rid of this. This is our portfolio, which encompasses these two strategies. Great. Now I will load my strategies for the other days, Tuesday, Wednesday, Thursday, Friday. I will make a portfolio of each day and we'll continue the video. So I made these 12 strategies over, so 2 on Monday, 2 on Tuesday, 4 on Wednesday because of that report day, and then 2 on Thursday and 2 on Friday. So 2 every day except for Wednesday I have 4 because it changes dramatically within 4 hours. And even though Wednesday they are not all good strategies, but like I told you, the magic is in the portfolio. So once you get to this point, you can just click on all of them and merge in a strategy. So let's call this CL weekly portfolio. Now you're only merging the results of the strategies. So there is no code here, and the code is experimental right now, so I cannot trust it. Basically, I'm doing, when I combine all of them during this period of time, which is about 10 years, then we get about 5,500 trades, and we make about $250,000. You can see this is the portfolio, and this is the drawdown. And you can see the portfolio and its parts. So these are the parts. The color is one, and the light blue is our portfolio. And also we can see the correlation, which I showed you before. Now you can see it's all green, and weekly it's still, and monthly it's a little bit dark green we get in some strategies. But all in all, there is no overlap at all by design, of course. And here you can see the overlapping trades, And these are just happens to be probably on holidays, just half trading days, where you get these overlaps. And these are the stats. It's we compound annual growth at 34%, and our drawdown is 13. Of course, this is one curve. So in order to do the Monte Carlo testing, for some reason, I couldn't do it in here, which is basically to test for Monte Carlo trade manipulation, because trade manipulation doesn't use the code, it just shuffles, reshuffles the trades. And it's very frustrating, of course, but still I try to solve it in another way. That is, if with your license of SQX, you get a license for Quant Analyzer. This Quant Analyzer is actually some of the robustness testing, which is only this Monte Carlo and what if simulation, limited what if simulation, and this part of Monte Carlo testing is in this package. I brought all the systems here, and you can see that. So this is system 1. So anyway, now when I combine all this into a portfolio, I get this portfolio. And these are the parts, and this is the sum. It's very similar to this, except now I can do Monte Carlo testing here, because as I told you, for whatever reason, this is not letting me do Monte Carlo testing. So here, again, tricking SQX in a different way. So we can do Monte Carlo testing here. And the whole point of Monte Carlo is to find out what's the optimum initial deposit that we need to run this portfolio. Now, these strategies, I added some of them with stop loss, some of them with a profit target, and some of them with both, and some of them with a daily filter. I think 3 strategies has daily filter here. So it's a little bit enhanced portfolio, let's say. Still, we're making about $250,000 at the end. First of all, let me show you the trade analysis. This is now on the portfolio. And you can clearly see that we make most of our money on Friday and Monday. So I did another portfolio, which is only trading on Monday and Friday. So 4 strategies. But I don't see the point really, because all your trades are not overlapping. And you can see that November, it's all in all is a loss. But if you remove that, this is like about $1,200. So in the big scheme of things, it's not worth it to remove it. Remember, this portfolio work very nice. And also there is something to see here, which is 2009, it's almost an outlier. So even if you remove the outlier, let's say this year makes 30,000 instead of, let's say 70. So you lose 40,000. So even if you lose 40,000, that's 210,000. So that's still a lot of money over 10 years on initial deposit. Currently it's 10, but let's see what we actually need. So all this is good. We have these stats and portfolio correlation. We already saw that. Equity chart. And then, of course, you have the list of trades. Now this is for the whole portfolio. And you can see that there are no overlaps. And this is the total overview. For Monte Carlo analysis, I'm going to do 250 because this is probably an old JavaScript here. So I noticed that it takes really a long time just to load graphics. So I put 250, although I did my testing on 1,000 and 5,000. 5,000 took really a long time just to update the screen, not the calculation. So if you do a simulation on 250 simulation and just randomizing the trades with resampling. So we're just reshuffling the trades and you run the simulation and then you'll come up with these curves. And you can see I click on it and it just takes time to load. And this is only 250 curves. So with 5,000 curves, it took like, 7 minutes probably. So from this, we see what? This is our original curve. And clearly the original curve is an outlier in the beginning, which coincide very well with this. We know that the beginning was an outlier between 2009 2012, and our average is around $18,000 or even less, $15,000. So this curve was not, we should not expect that, let's say, in the beginning. What's nice, it's in the beginning. It's 2009. So we care about the later years, and the later years, our curve is in the middle. So actually there are almost more than 50% of curves happening above it. So we can get these curves also. And of course these. So, but the whole point of this is what? Is to see our confidence level at each iteration. This Monte Carlo test is a tree shuffle the trades of the portfolio and then produce these figures. So at 95%, I make 159,000. That means that I have less than 5% chance of making less than $159,000. Let's make this 160 to make it easy. So I run this portfolio. My chances are less than 5% that I will make less than 160. And my chances are less than 2% that I will make 150,000. And I am 100% confident that I will make 113,000. So 50% chance making 250, and it goes down as you increase the confidence level. And the maximum drawdown, of course, increase. It's the opposite of the net profit. So at 95%, I have 5% chance that my drawdown will be more than 21,000. And here I have 2% chance that my drawdown will be above 23,000. But I am 100% confident that my drawdown will be less than $30,000. And this is very important. This is based on a $20,000 account. So if you see the curves, I have zero risk of ruin because none of my curves goes below 5,000. So my risk of ruin starts at my initial account is 20, but at 5, at 10, at 15, this is the initial deposit. I have zero risk of ruin. That means my account will not go to zero in any of these instances, even if I deposit $5,000. Because why? Because I never make a $5,000 loss. Like this is the lowest point here, and you can see it's $4,530. We need some initial margin to initiate a trade. So remember, we're trading one contract at a time. And if I pull up the interactive brokers, this is my broker, and you can see that the margin, which is a crude oil on NYMEX. So the initial margin is 5,125. This is the intraday, and the overnight is initial is the same. So the highest margin required is 5,125. So let's say it's $6,000. So at least you need $6,000 to initiate a trade at any point in time in these curves. So that means my $4,000 loss, even though it didn't go to zero, even though my account didn't go to zero, but I have $4,000 expected loss. And if you do this at 5,000 iterations, the loss actually is 6,000. So 6,000, and my minimum requirement to initiate a trade is 6,000. So that means my account should be 12. And just to be on the safe side, you put it at 15. In order to trade this portfolio, $15,000 should be enough. Now, this is my portfolio, and I have some stop losses at 200 pips, 200 ticks, which is $2. And that's $2,000 per contract. So you need to perform this test if you pick different stop losses and different profit targets and so forth. That's the whole point of Monte Carlo, is to figure out what's the amount. But I'm teaching you how to do it so you learn how to do it instead of copying me. So again, the point is finding the lowest curve here. What's the lowest loss? And add to that the initial deposit needed for your instrument. And add to that some wiggle room. So 6 and 6, that's 12, and some wiggle room 3, so that's 15. So on 15,000, I can comfortably trade this portfolio. Now we can do something else. Now we know that, at 15,000 is good, 20,000 is even better. So now we go to money management. And I put the initial deposit, let's put it at 15. The simulation I'm gonna run is the fixed percent account, 5% per trade on one lot. And when my account grows, I'm gonna allow it to maximum trade 15 lots. That means 15 contracts. And I'm gonna run a simulation. And this is our equity chart. So this is the original. The blue is the original portfolio. And this is the drawdown. And then the red is the one with the money management applied to it. And you can see the differences. There's no need to compare. You do have, of course, bigger drawdown, but it's nothing to write home about. It's very okay. You know, it's about 23%. So you doubled your drawdown here. You 1.5% probably here, and then less drawdown as you go further. But the amount of money you make is, let's see, here is easier. It's 4.4 million. So the first one with trading single contract is 250,000, and this one is 4.4 million in 10 years. All these tests should be doable inside SQX. It didn't work for me, and I'm gonna follow up with it. But in order to finish this series, I just had to show you how to implement this portfolio. So once you build the strategies, how to come up with a number that assures you that you will not go broke. Basically, you don't wipe your account, and how to figure that initial deposit. The methodology is very robust if you know how to use it, and I show you how to use it and how to apply it. So I hope that was very beneficial to you, and I hope you use it to build a portfolio and make money on it. So probably in a future video, I'll combine the code and share it with you. So until then, stay safe. And as usual, please share, like, comment, subscribe, and I'll be happy to answer all your questions, and see you in the next video. Thank you for watching. I hope the series was very useful to you and you will make some money out of it. Please do share, like, subscribe, and comment so Google can push it to other traders. And until the next video, stay safe, and I'll see you soon.